On today's video, I'm going to show you how to read the market, how to use market structure effectively to know directional bias of the market and pick quality trades. Initial idea behind market structure is for the market to create series of higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. And when we have a change in market structure, you are expected that the market structure is shifting and you should now continue to go on a downtrending market. And this is most of what you see on the internet. But in real life, when you come to the market, when you come to the real market conditions, you will see that your crutches are not holding. Your change of market bias would not hold, and instead of this, you will see that the market will just continue going up high. On today's video, we are going to be showing you why these crutches are not holding, why your change in market bias is not holding, and how to take effective use of this strategy as well. Now, this video which I did on supply and demand, you should watch that video. On that video, you will have a clear understanding of how to navigate the knowledge you get on that video and the knowledge you are going to be having on this video. So let's jump into the class as a whole. Now, the first thing you want to do, you want to be able to identify where the market is going. Either we are on an uptrending market or a downtrending market, and it's very simple. It doesn't have to be complicated, it has to be very clear. Now, if your market is going on an uptrending market, you want to be able to understand the directional bias of that market. As you can see, this is very clear that we have this market to be an uptrending market. One thing you should know is that you don't force analysis. Once you are not clear about the direction of that particular pair, you just let it be. You should be able to identify a clear uptrending market by the series of higher highs, higher lows, higher highs, higher lows, and the series of higher highs and higher lows that is great. Once you are able to identify the directional bias, then you'll be able to make use effectively of liquidity and market structure. Now, this is a clear structure on how to identify lower lows and lower highs. When we have a lower lows in the market here and we have a lower high, now it is expected that when we have another break, this retracement should not go past this section here until we have another break in market structure. After this, you don't want this section to go, and sometimes these things fail, and I'll show you why. So let's jump into the real chart right now and let's do some paper work before we go to do how analyze it on the real market conditions. Now, on the previous video where we talk about supply and demand, I told you that this is a very important zone you want to look out for on the market. This is a zone that when the market goes up, it come back and respects your demand level. When the price goes up, break in market, have a break in market structure, it come back and respect that level and go back up. Now, in this kind of market scenario, it would not do so, and I'm going to explain why to you. When we have a market like this, that retracement is coming back to take out this zone, and after you take out this zone, it is not a change in market structure. It's just a liquidity takeout because the market has nothing to trigger it to move. It's just a liquidity takeout, and the market will continue going up in its initial direction. Let me give you the scenario we have over here. Now, this is the same scenario here. We have the higher highs. From this point, we have a higher highs, we have a higher low, and we have a higher high over here. Now, this here is our demand zone. Over here, we still have our demand zone where we expect the market to come and hold. In this market condition here, the market would reverse back and respect our demand zone and just buy from there. Do you know why? We have a fair value gap. Where's our fair value gap? After we had this retracement, after the market gave us this push to the upside, after we have this retracement, from this point here, count the candlesticks 1, 2, 3. We use 1, 2, 3 to measure our fair value gaps. You can see that we have high buying pressure in the market. We have a good amount of high buying pressure in the market, and this high buying pressure, it left us with fair value gaps. Now this is the fair value gap here. We have a fair value gap, a gap that is yet to be filled compared to this other market condition. As you can see here, there's no gap, the market filled everything and there's nothing for it to come and respect. So when it's coming down, we come back for liquidity. In this zone here, we have a fair value gap that when the market is coming back on that retracement, is going to fill the fair value gap zone. Is going to fill up the fair value gap zone and is going to respect the demand area here to just continue pushing to the upside. So it's very important you watch out for fair value gaps on your supply or demand area before taking a trade. If we have a fair value gap in your demand area or your supply area, it simply means that trade is likely to hold more. It's likely to hold more and continue in the initial direction. If there are no fair value gap, there are a lot of possibility that will just come back and use that point for liquidity. So this is how you want to be able to take advantage and to know where we have fair value gaps and where we don't have fair value gap on your zones. Let me give you another case scenario of what you will likely see in the market again. Still talking about fair value gaps. Now the market moves in structures here, higher highs, higher lows, higher highs. And when the market is very bearish, the market would just give you higher lows from a particular point and it just keep going up. In this kind of scenario over here, we still have fair value gaps at this point. We still have a lot of fair value gaps at this point. All of the zones here, we have a fair value gap at this point. And in this case, we still have a breaker block here where the market will likely come to retrace. So you don't consider that zone as a break or a change in character. Let me give you a clear scenario here. Now, if we have a very normal market condition, the market should just give us higher highs. This way, higher highs, higher lows, higher highs, and the retracement should come back all the way down to the 50% to respect that zone and to just fill up every other gap and continue moving in the initial direction. But in a scenario where we don't have this to happen and we saw the market giving us a good amount of gaps here, the market in this case would not obey our demand zone over here. Instead, what will happen? The market is likely going to come back down. Respect this zone and take out this zone as liquidity and use this zone for a buy. Use this zone, which is our breaker block level, use it for a buy, and it will just bounce back from that point and continue in the initial direction in which we have. Now the market is still on an uptrending market. What happened was that it just came back to fill in those void. It came back to fill in the fair value gap we had, and it looked for a zone to respect from to buy, and the zone that is going to respect would be your breaker block level. If you want to learn more about breaker blocks, subscribe to the YouTube channel. On my next video, I'm going to break down how to understand breaker blocks level if you're still confused on that. But let's talk about a little bit of breaker block here. Now, this is how to see your breaker block points. When we have this market, we have higher highs, higher lows, then we have a break, higher highs, a higher lows, leaving us with a little bit of a fair value gap. Then we have another break, higher highs. Now this would be your breaker block zone. This candlestick here, this particular candlestick is your breaker block zone. So this is the candlestick you want to mark out and expect the price to come back and trigger from there. So in this kind of market scenario, if the market is coming down for a retracement, it will just come back, take out the zone as liquidity and hold that demand from here. It will hold that zone from here and it will continue going in the initial direction in which it was going before. So this is how to really understand market structure on a more defined level. You want to understand where we have fair value gaps. You want to understand where we have liquidity line. You want to understand your breaker points axis. So that is it for it. Let's go to the market, to the real market. Let me give you a little bit of an analysis on ADA USDT before we call this a day. So market structure works on all time frames. It's the same principle, like it works on the same principle. Now, as you can see, we have a declining market from this point here. As you can see, the market was creating series of lower lows, lower highs, lower lows, lower highs, and it was just selling on other USDT. It was just selling all the way to this point here where we had lower lows, lower high, lower low, then we had a lower high, we had a lower high, then we had it come back down, take out liquidity, lower low. And what happened from here? The market broke structure. So you want to follow up on all the structure on the higher time frame before going down to the lower time frame to get your biases. Now, after the market, from this point here, we saw the market break structure. Now, I mostly preach about to break a market structure for you to confine and change in direction. You don't want to just identify a change in direction because we have one break. You want to see two breaks, which is this we have here. One break, trace, second break. Now this would give you an initial bias that the market is changing structure, and from this point the market now reverse back, taking out this zone as liquidity and respecting the demand zone we have here, which is the demand area. And what do you see from that point? We saw the boost of the market, the market boosts. Now if you notice, the market came back to this zone where we have a lot of liquidity lying on the daily time frame. As you can see, I mark out that zone, and the market came down there, and boom, what do you notice? Higher highs, higher lows, higher highs, higher lows. We tried to push up, there was not enough volume, then we saw that break. After we saw the break over here, what happened now? The market went back and it started to respect the zone from this supply area we had here. So if you notice, let me draw this out a little so you don't get confused. Now what is triggering this sell is that liquidity point we have on the lower time frame. That's why you see it took it out like this, and this is our zone here. This is our supply level, and this is on the daily time frame. Yeah, so we already have an initial bias why the market should drop on the daily time frame, and this. So let's go back. Higher highs, higher lows, higher highs, higher lows. Wanted to go up, not enough volume, then break, change in market character. Now where's your key zone? This is your key zone here. This level is your key zone over here. Now when the market came here, as you can see, I didn't take a sell entry directly. I could have taken one, but I didn't take any sell entry. I want to confirm that this trend over here was actually selling. So when we started seeing the sell, you just switch to a lower time frame, and on the lower time frame, which I love to use, the 5 minutes, you could just look for your initial bias. You can look for any bias. Market structures work on all time frames. So this is how I had this one here. From this point where we have the lower low, lower high, lower low, as you can see over here, there was no fair value gap, nothing for me to trigger any entry here. So I know that the market will definitely be coming out for this liquidity, and that was why I took the trade. And as you can see, it came for that liquidity, and what is it doing now? It's going to go back down and continue in that initial structure in it was forming. So this is how you look at the market. You want to know when the market will go for liquidity, when your supply zone is strong enough or when your demand zone is strong enough. Now if we had a fair value gap around this zone where we have a very big push, then there's every possibility the market don't have any need to come for liquidity. But since there were no fair value gap here and everything was filled, the market would come back and it will hunt for liquidity to continue moving on the downside. So that is it for this video. Do ensure to subscribe because more quality content will be coming your way this year, and have a lovely weekend.